Happy September. Welcome back to Stock Market Weekly. I'm your host, Evan Medeiros. This is the show that catches you up on all of the notable moves across financial markets through the lens of technical analysis. We publish every single Friday. Make sure you tune back in on the weekends so you never miss an episode, so you're always prepared for the week ahead. There was a lot going on this week. There were lots of moves under the hood, sectors, individual stocks. We're going to look at all of it this week. We're going to spend a good amount of time paging through some charts in TC 2000. I've got a light slide deck prepared here, and then we'll just focus on some of the price action and what the market is telling us through some of those charts. So let's get into it. Hope you're doing well out there. Our video today is sponsored by Investors Business Daily, Market Surge, and their IBD digital subscription. I've got a link on the screen. I've got a link in the description of this video. I got a link on the website. Check it out. If you haven't yet, try out Market Surge, see what you're missing, see if it can help you chart, analyze, and research stocks just a little bit better. Now, first and biggest story, of course, this week was the August jobs report. It was weak, to perhaps an understatement. I think they were analysts expecting 75,000 jobs. We came in the 20,000 range, so much lighter than expected. Obviously, good and bad parts of how that translates to markets and the economy. It does boost the odds, though, that the Fed is going to be on a rate cutting path more convincingly and perhaps more steadfast in how many cuts we get this week. So that was the big catalyst, the big news. We do have some econ data next week, but for the rate cut crowd, it's pretty much a lock here that we are going to start to see lower interest rates. The second big story of the week was Alphabet. Alphabet is a huge weighting in the indexes, and we came into the week breaking down, or gapping down. There was weakness coming into the start of this week. It felt like the market was ready to roll, and then we hit this announcement out of the courts here that Google will not be forced to divest its Chrome asset, and that really took a lot of pressure and uncertainty off the stock, and that really helped lift the NASDAQ on Tuesday. Another saving grace this week was Broadcom. Broadcom had just a big, kind of turnout here on their earnings. They had this mystery buyer, $10 billion being, sort of earmarked for purchases, and that really boosted semiconductors on Friday. So lots of individual stocks moving. We're going to look at those stocks and charts later on to see what it means. But in terms of index performance this week, we have again the Russell 2000. I think this makes a trend, right? Because every single week now for 4 weeks straight, the Russell 2000 has been the best performer. And at least in the short term, this is rotation. It's sticky. It's persisting. And so we got a 1% move up. NASDAQ did claw back this week. Again, semiconductors, Google helped it, 1% up. SPY up 0.33%. Here's the SPY. Basically, it was, a holiday shortened week. Was it a holiday shortened week? Yeah, this was the Labor Day weekend here. And Tuesday, was basically the low of the week here. And then on Friday, we saw a little bit of weakness, little bit of a reversal here on Friday, right, to start off. Now, Tuesday, the way this chart is presented, right, it looks like we're just starting here, but this was Tuesday's action. So again, we had a good gap down on Tuesday. We're going to look at the price action closer in a little bit, so we won't spend any time on it here. Volatility sinking, kind of closing at the lows of the week, back down around 15, and the dollar index kind of all over the place this week. It had a big move up to start the week. It was looking like we were going to start to see kind of a leg higher, and then it totally, kind of petered out after the jobs report and some of that econ data on Friday. 10-year Treasury yield, I think this is the story this week as well. We didn't highlight it at the top, but we're going to look at these charts. I did post about it on social earlier this week. Bonds are looking good. 10-year yield is back down, or not back down. It is at now the lows that we've seen in quite some time, breaking below that infamous 4.2, going out towards the lows here. We're going to talk about that throughout this video. In terms of sector performance this week, communication services stealing the show here, 2.96%, followed by discretionary, and healthcare, oddly enough. And then we had, a good, breath push to the downside here. We had XLE, so energy, financials, and utilities all down 1 to 3%. So pretty meaningful split here in the market, depending on where you were invested. Now, in terms of our ways of sort of smoothing out the noise, we use something called our Smart Trend Filter. It's available for TC2000. It's available for TradingView. It prints these green, yellow, and red dots, and it helps kind of trend follow, smoothing out price action, incorporating volume, incorporating price action relationships, and it gives us that good kind of road to follow here. And so healthcare, consumer discretionary, and communication services, those are our top leaders here in terms of sectors. We've got a lot of folks kind of stuck in the middle here. This is our neutral state. It's telling you that things are choppy. It's telling you that there's some cross currents. It's telling you kind of look both ways before crossing the road. And then we have two sectors still in the red here. That's consumer staples and utilities. All right. 52-week highs and lows. The bulls pretty much dominated this week. Again, it's not like breathtaking numbers, but it is still a lot more stocks hitting 52-week highs than there are stocks hitting 52-week lows. You're looking at about 100 to 20, 5-to-1 ratio, 4-to-1 ratio here. We'll see what Friday's data looks like, but we want to see more of this. It's decent, but it's not fantastic. Bitcoin. So we talked about Bitcoin last week, the last couple of weeks, right? And I've been using this more or less 110-ish line in the sand, kind of saying it's, don't love it below it, like it a lot more if we can start to close above it. Here we go, teetering right at this zone here, this 110 to 111. It's still in this messy territory. There is a big announcement or catalyst potentially this probably in an hour or maybe before I even finish recording this with Strategy, former MicroStrategy, on whether or not that would be included in the S&P 500. Sounds like a small deal, but it's actually a big deal in terms of the flywheel of strategy and what they could do with those passive flows to accumulate more Bitcoin over the next, years, right? So that is a big deal. We'll see if that actually happens. Announcement, I think, comes on the S&P's rebalance after the close today. So that'll be interesting. But for me right now, Bitcoin, some of our models have turned off. I talked about that last week, where essentially they started to divest a little bit from Bitcoin. And so, it's in choppy territory. It just needs more clarity. I want to see a good push up or a good push down, and we'll take it from there. Upcoming econ events, I think CPI is going to be the important one next week. So that'll be Thursday. And we also have the producer price index as well on Wednesday. So both of those I think will be interesting to pay attention to, and will help guide this picture in terms of the rate cut and the Fed and everything that they want to do from the data standpoint. So let's get into some charts here. We've got a lot more to cover. Stick around. All right, here we go. So S&P 500, we're looking at the SPY right now. We'll switch it over. Okay. Here we go. We got TC2000 open. We're going to start off with the S&P 500 here. This is the cash settled market. And this was the price action this week. So again, we had Labor Day holiday Monday, so markets were closed. We got 4 days of trading. This is how we started the week, right in here. So we had a pretty ugly gap down, and we had a good probe lower here down to the mid 6,300s in the S&P 500. So at the lows of the session, that's a good 1.5% down for the S&P 500. Last week, our commentary was that gap down was kind of setting up. It seemed reasonable. We talked about kind of the cracks, the bear setup, the fact that the market kind of rejected here in this very quick, kind of popped its head up and then failed. And we didn't like that look. And we said, be on the lookout for this market to take a dive lower, see if the bears can break this market down. And, that proved to be perfectly correct for about 8 hours of trading. And that was about it, right? So we're back in this whack-a-mole story where the sellers cannot get their hands around this market, right? Every time we start to see this little bit of slippage and these cracks in the market, when you start to break some of those near-term technical levels, the selling dissipates and the bid appears and the market floats higher, right? And this is a very painful experience if you're a responsible tactical trader that is trying to manage risk in a very tight fashion, right? It can be very costly to get to the sidelines when you start to see the market roll over, and then it just doesn't follow through, and you're forced to either chase back the market, right, buy in higher, or or you just stay sidelined, right? Or you stay short. That's even worse, right? So pick your poison. But this has been the story of the market here, and so Monday we had the gap down. We hammered out here, and then this is why I say the Tuesday. I believe it was Tuesday. I'm sorry, the days are messed up. This was Tuesday. This was Wednesday. So it was the Google story that I think, helped a little bit just kind of buoy this market back up, right? When did Google break out? Was that Wednesday? Yeah, that was Wednesday, right? So we had a 9% move up here in Google. The amount of flows and action there and what that does to the market cap weighted indexes, that is substantial, right? And so getting the S&P 500 to crack, or the NASDAQ to crack when Google's going up 9%, you really need a lot of other things going the other direction. And so that's why I say I do think Google did come to the rescue this week. And potentially, save the market a little bit. And then we had, gap fill, and then we had, this nice Thursday push up with Broadcom coming out after the bell again, kind of helping squeeze this market up in anticipation of the jobs report. And then Friday we got left with, kind of some failure once again here to stick our head above this general zone, right? The market seems a little bit tough staying above this 650, but again, buyers had a good drive off of the lows. So all is to say, the market did not break down. We're still in an uptrend. You could, make the case that we are more sideways now than in a strong rip roaring uptrend. There's definitely some rotation happening under the hood. There's markets there's individual stocks picking up the slack. But for now, S&P 500 back towards highs, saved itself from a breakdown. I would say you need to see follow through in this market. You need to see selling pressure sustained for more than just a couple of days before we can get too excited on the downside. So for me, 640, 641, this little midpoint here is what I would be paying attention to as an active trader. If we start to break below 642, you could maybe say break below Friday's lows. If we start to see something there, maybe you could build some momentum to the downside, but it's been really difficult trying to call these breakdowns here. And so bulls got this market back up towards highs. NASDAQ 100 didn't quite break out, right? So it's still off of its highs here, but it's been going sideways and underperforming on a relative basis for a longer period of time. But the Qs have finally, started to make more of a stand this week. So more sideways here, hasn't quite broken out. It's just a choppy sort of sideways range here. It's digestion and it's some cross currents in the major indices. The Russell 2000 has probably been the cleanest spot here to be just more on that glide path higher. It has been putting in more technical kind of higher lows and grinding and, just a more orderly, process here as it finds its way back up towards these prior all-time highs. So that rotation under the hood to small caps is still happening. So that's kind of the lay of the land there. Much more neutral on this market now. I think back to respecting the uptrend. I think this was the shot to break the market down coming into the week. Failed. So that's it. Let's see if we can get another breakdown attempt. But for now, it seems choppy to higher to me in the major indices. I think the big story this week was IEF. This is the 10-year Treasury. You could look at we look at the Treasury yields in the slide deck. This is the 10-year Treasury bond fund, IEF. And this, I posted it on Thursday. This looked good. And it's the first time I've thought that for years. And in fact, I swept on Thursday my excess cash into IEF and duration for the first time in years, where it was, any cash I have in a trading account that's not active in a position, I generally will, either buy Treasury bills directly or put it in BIL ETF or something like that. This time I said, you know what, IEF looks great. This looks like where I could just park some short-term temporary cash, and so far, so good. So we'll see if this can continue. It's had a nice push here. The jobs report was the catalyst, and this is obviously the inverse to interest rates. So 10-year interest rates down to 4.10 now going into the weekend. You can look at TLT too. Look at the volume that came in on Friday. This chart looks pretty good. Look at this weekly bar here on TLT, gap down to start the week, and then it just engulfed 6 weeks, right? 1, 2, 3, 4, 5, 6 weeks of trading to the upside. And so it's pretty significant. I don't think this is adjusted for dividends or anything. This is unadjusted, but still bonds, meaningful move. So let's pay attention to that. Gold, I think, is also meaningful. Broken record about GLD, posted it's my largest position, still my largest position. Gold looks great. It's very extended. Had plenty of time to buy it in here. If you're chasing it now, I mean, if you're quick and you're playing momentum, I guess that can work. But it's extended. I mean, look at this above the 2 and 20 Bollinger Band. Throw it on a weekly chart. It's pinching and, you know, really pushing out. But there's a lot of fuel in here. Since April, it went basically nowhere. So it's starting to expand. Volumes coming in. It's everything you'd want to see. GDX, this led the move. This started to break out early. We were on top of it. We talked about it that first week when it started to break out. And it's been, you know, basically up ever since, another 15-16% higher. And silver also getting some big volume coming in this week, and also, you know, kind of accelerating and breaking out. So all the metals are working right now. You know, some of that dollar weakness and just a lot of other factors, obviously, that go into that trade right now, but continues to look good here going into September. Oil is definitely a tougher spot. It was down 3% this week, kind of back to this choppy range. Don't have too much to say about it. I wouldn't be shorting it. I'd still be looking for probably longs on USO, but I haven't really pulled the trigger on this. XLE is probably a little cleaner, but this price action wasn't great this week either. So that's kind of just stuck in the mud. In terms of some of that interest rate sensitivity here, I think Homebuilders are interesting, right? Because we do see interest rates coming down. We see mortgage rates coming down to 12, 14, 15-month lows, basically lows to last year. 30-year fixed getting closer to 6%. So that's starting to, you know, peak the interest here in Homebuilders. XHB breaking out here up 5%, not quite back to highs, but certainly putting in some good structure. So XHB, don't own any, but it is working. Biotech, right? We talked about Biotech, I don't know, I think it was last week or the week before. This continues to see rotation, continues to see some pretty good volume coming in, and good performance here. Is up to almost 2% on Friday. That's IBB. Could also look at XBI, and to a lesser extent, you know, healthcare, which is certainly the more defensive, conservative area of it. I mean, this looks like a good bottoming pattern here. It hasn't quite triggered, but you know, if you are concerned about technology and some of the setups you're seeing in high beta land, and you do think this market is days or weeks from some type of pullback, then, you know, XLV isn't a terrible place. Again, full disclosure, I have position here, so XLV is something we own, but the setup there is kind of nice. So so that's working there. I think that's it for all the major sectors. In terms of individual stocks I wanted to talk about, Google was the first. So here it is, right? This is kind of the catch-up trade, if you will. It was left for dead. Everybody was dunking on Google here at the beginning of the AI race as everything was heating up. And now it's really starting to, you know, hit stride. It's up 24% year to date. It's breaking out to new highs. The trend is up, volume's coming in, life is good. So Google looks great. I like the story. I've owned it. I don't own it now, sadly, but you know, it looks good. I own the Qs, so I guess, you know, implicitly I own Google. Broadcom. So this was Friday's action here. Didn't close at the highs. There was some selling pressure, but it was also a huge move, right? So earnings, again, big buyer coming in and more commitment here to the AI trade. This trend has just been, up and to the right, very strong. A little more, it's got more wiggles behind it, if I want to use the technical term. That's ebbs and flows a little bit more. Not a super momentum type stock, but if you've got more of a relaxed trend following filter on this, it's worked out pretty nice. So Broadcom helping move things in the right direction. One sector, going back to the sectors I wanted to highlight, was financials. Pick this one up on Friday. I didn't pick this up in terms of a notable move. This is a pretty good rejection here on Friday of XLF, right? And financials have been a pretty nice spot to be over the last weeks or so. But this is a pretty notable heavy volume kind of bearish reversal, bearish engulfing bar here. So I would pay attention to this, and it's kind of cracking up at and losing some levels here. So if this finds follow through down, or maybe this is your short exposure if you're not willing to take a shot on the S&P or the indexes, I think this is interesting. So a little bit of short-term reversal action there that I think is worth calling out. In terms of some other individual stocks, and then we'll call it a day. Lululemon, this got slaughtered here off of earnings. This was a big growth play for quite some time, and it's really sort of rolling over, potentially that stage 4 kind of decline now. Got to be careful. It's look at Nike. This is the dip that keeps dipping. Obviously, it's coming back a little bit, but retail has been mixed. It hasn't been straight up bad. It's just been mixed. There's been winners and losers here, and so getting really hit hard there. Palantir also I wanted to highlight. So Palantir I think is worth paying attention to, because to me this is almost like the poster kind of meme stock, and it's not meme in that respect, but it's just a lot of retail following, a lot of hot money, a lot of hedge funds, just a lot of attention here, right? This is emblematic of a lot of the growth trade. You could look at Robinhood, you can look at a handful of different names that kind of lump into this category. So I don't mean meme in the derogatory sense per se, but it's looking a little precarious here, right? Like this is a consolidation worth paying attention to. This weekly bar is the heaviest volume in the stock's history. That was a few weeks ago on the decline here, right? This is the heaviest dollar volume the stock has ever traded. Those are weeks you take notice of, and right now it's consolidating at the lower end of that range. And so it doesn't have to end badly, but it's something you want to watch, because if we start to lose this 150 area, we could see a big, not a big, but a swift decline back down to the 130s or so, and kind of come back down to the July, levels here. And again, the stock has covered a tremendous amount of ground with no meaningful pullback. So again, just a little buyer beware here. The story doesn't have to be over, but I would be paying attention to this consolidation. And if that does break down, I think you do have some, potential spillover effects into some of these other names that are highly concentrated and trafficked by the same type of holders. So I think that's it. That's what I've got. Mixed market, a difficult market. I think this is a hard market here in the short term. I would just be careful. Less is more right now, is my opinion. Our trading systems are, our short-term trading system is very defensive right now. Our longer-term system is still engaged in trends, but there are some risk-off, divesting signals it's got recently for the first time in a while. So a lot of mixed messages, difficult market. Be careful. September is a tricky one. So that's what I got. Hopefully this was helpful. Thanks as always. We got links in the description of this show. Hope you have a great weekend. We'll see you back here next week, I hope. Take care.